With the S&P 500 bouncing to conclude November and now getting closer to its former high points, we're going to focus on this specific index today and actually look at it from 8 different perspectives. Let's dive in. And we'll start with the long-term view. And as we know, it took a valiant effort, but the S&P was able to log its 7th consecutive monthly advance in November. So clearly utilizing the huge reversal that we saw in April and then riding it all the way through. And of course, this isn't anything out of the ordinary. Going back to at least 2017, we can see how many times we at least had 5 straight up months and 7 last time occurring in 2021. And going back to 2017 was a time we had longer than that with 10 in a row. And we know that we've been comparing 2025 to 2017 in various ways, but 2017 is historic for a reason. The volatility was extremely low and extremely consistent. We had some bumps along the way recently, which we'll talk about. But the question is, of course, what comes after 7th straight monthly advance? Well, let's look more closely at the last 8 months. Again, this was April, finishing near the highs, but not quite a gain. We go then 1, 2, 3, 4, 5, 6 really strong months with the closes right near the highs each time, including this last one. But if you compare this most recent monthly candle to what happened over the last number of months, it looks much more alike April compared to the other ones. Now, the big difference, needless to say, is that this one is occurring 40% higher than what we saw down here. So can we really expect the same kind of upside follow through after this? Probably not. I'm going to guess that we're not going to be up 14 months in a row at this point, but that's not really what matters. What matters most is what comes after this. And remember, for the last 6 weeks, there's been a lot more to a volatility. This goes back just to what happened in November alone, right? 4 1% moves to the downside, 3 1% moves to the upside. So having 7 for the month was the most since we had 12 back in April and of course March too. And combined to what occurred from October 10th through the end of November, we're now at 12. So again, 12 over the course of almost 7 weeks is a good amount. And that really changed things. If we look at the chart, we know that we're looking at all those bullish patterns, all those targets got hit right until the beginning of October. And once it got there, of course, we called it a jump ball because at that point, there were no more big bullish patterns out there. And it was up to the S&P and really the bearish traders to do something with that. And so, that was a period of elevated volatility. So the question is, number one, is that period now behind us? And if it is, can the S&P replicate what we've seen over the last 2 years coming out of elevated volatility? And so one of the things is to look at is, again, much different. This was July, this was September, and we had 0, 1% moves. But since that point, again, once we hit that level here in October, that's when things change. And no surprise to anyone, when you have a lot of big moves to either side, you just have a lot to volatility. And you look what happened here. Just about the same spot to end November as we were when we first got that big downturn of 3% on October 10th. Now, the next chart is arguably my favorite one that we show. And that's showing, again, these other periods of elevated volatility and what came next. We're not talking about the lows. We're talking about what happened after the lows. We always need really strong effort from the bulls, which we had each and every single time, including just last month, as clusters of big updates. And so, again, next step is to not only get to new highs, but then see that character shift once more to what? Lower volatility as well. So the character will shift. It'll become boring once more potentially, but that is how extensions work. So is it enough? Even though we only got a pullback of, say, 6%, is it enough to trigger this? Or are we facing one of these situations where at the end of December last year, same type of thing, we got a consolidation after making a new high as the month began. But of course, that was short-lived and we know what happened after that. So it will be telling, but again, if we're going to get that last ditch effort, last 4 weeks of the year, strong gains to finish a strong year, then we look for that same type of shift in volatility to happen once more. So of course, when we have lower volatility, sounds like a broken record, but we know what happens next. It helps bullish patterns form, more importantly, have cleaner breakouts. And that is what has been missing recently. And so again, we're looking at this from a 60-minute point of view initially to see the first instance of a bullish pattern after the late November low here. And we got that push above this 6760 zone and trying to hold in there. Now, and if it does, that means the target of 7,020 will remain in play, as we know that is a good deal higher than the prior high here, which was right around 69.25 from late October. So as this is trying to hold, we still have the ability to have something like this play out, right? This is the potential bullish formation. If it worked out like this could be a cup and handle pattern. And again, said it before, said it all the time to our clients and also on X, when you have a larger amount of volatility or bigger the drawdown, the bigger the resultant bullish pattern that can form. And of course, that then leads to higher targets once more. And needless to say, it got down to just about 6,500, just above 6,900 here, 400 plus 6,900, right? 7,300 around that. That would be the target if in fact we get back up to those levels, right? And so that would be pretty high. And again, I get asked all the time, the timing of that. There is no timing to patterns. We get a breakout, we respect the breakout, put that measure move on top of it that remains in place as long as the breakout zone holds. And that will be the most important part of this. So if you're enjoying this content and want to see a lot more of it, I urge you to check out our free Cap Notes newsletter, which you can find on capnotes.substack.com. As you can tell, we put a lot of free, really helpful content on here. On occasion, unlock full reports as well. And if you sign up today, you can receive our 6-step trading process that powers winning chart trades and limits losses. This is a simple, proven framework for spotting high probability setups. Ask anyone who has signed up here. They enjoy getting that free report and, of course, receiving all of this other free written and also video-based content. Again, it's capnotes.substack.com. Look forward to seeing you there. So in terms of bearish patterns, guess what? They failed again. And we had 2 of them live, and we talked about this a lot. At first, they were put on hold because the initial snapback and the excessive volatility that we saw before, thinking that it could come back and have these necklines re-trigger to the downside. Didn't happen. So the first target of 63.60 got negated, as well as the deeper one of 62.20. And guess what? We've seen this before. Now, these two were different in the fact that they came off of the highest level that the S&P had been on, and there was a more substantial break to the downside. Again, substantial, they're only down below this key neckline for a few days, but much different than we saw before, where support held almost every single time, not even getting to the point of testing what it would be like underneath those breakdown zones. But, we're always looking at the potential for the next one. And, if the S&P continues to rally, this is going to be voided as well. But as we can tell, this still could be considered some kind of iteration of a topping formation. So we'll continue to track it. But, some more upside follow through this will be completely negated too. Now, in terms of seasonality, who do we turn to for seasonality? We turn to Jeff Hirsch of Stock Traders Almanac. As we can see, no matter what index we're looking at, kind of takes a similar path where you have kind of a good start and then a weak middle and then a strong finish. And so if you think about it, if we're just looking at those bullish patterns form, if we do rally, maybe another few days and then hit some resistance, maybe that coincides in the last Fed meeting next week, then we see a pullback, and then that pullback is bought, that could form that higher low, which could then complete the cup and handle pattern as we get to the second half of the month and the positive seasonality kicks in. That would line up quite well, which we know that things don't always line up well, but that would be the best case scenario if this plays out once more. Now, the short term has been helpful as well. And one of the things that we're looking at all on the way here as the market was trying to rally and failing was that this 14-period RSI on the 2-hour chart just couldn't get going enough to produce an overbought reading. So that just kept these rallies from being too aggressive. So they were capped, producing lower highs, lower lows on the downside, with both of these periods producing oversold readings. But the most recent one did not, right? The little small pullback, and we did not get to oversold territory. That kind of gave way to the round of buying that we saw again at the end of the month, which produced that 5-day winning streak. So now, still waiting for the overbought condition, got close, as of the close on Monday, December 1st, getting closer again. We really want to see that happen. It just would tell us that we're back in this mode of 2 steps forward, 1 step back, as opposed to a reverse. And what that has happened in the past, as we talked about, most of the time has coincided with making new highs. And with the S&P very close to its former high point now from October, of course, that will be an opportune time for that to happen relatively soon once more again. Now, one of the things that hasn't happened since the April lows is that we have now a MACD buy signal. We talked about 10 different MACD sell signals that happened since that point, and almost all of them failed. It just tells us that the market continues to rise. But with the MACD indicator itself, staying above the zero line the entire time, there was no way to get a MACD buy signal, even with the market up so much. And so finally did, as these lines eventually, after gradually moving lower, went below zero. On the reverse, now 2 or 3 days in, we have a MACD buy signal. We go back to now the low from the bear market in 2022 in October. We can see how many times that we had MACD buy signals. Now, there have been a handful of them, not nearly as many as we see on the sell side, only because why? For most of the time, the indicator itself has been above the zero line, so there was really no way to get a buy signal. But now we have one for the first time again since really the low in April. And so we have plenty of occasions here in the past, while MACD buy signals occurred during uptrends after short-term pullbacks, and what do they end up doing? It ended up being very good buying opportunities. And so we should not ignore this one again, even though it's happened after a 40% advance. And so it makes sense to realize again why this has occurred now and not before. Well, it's all because of what happened on the way down, where the move to the downside was so severe, it happened so swiftly that it caused the difference between the lines to get so extravagant that it produced one of the biggest or the lowest readings ever on the MACD itself. Again, the only one that was worse was what happened during COVID. And just math, right? The higher the level of the S&P 500 itself, the higher the level of the moving averages that it deals with, that's going to produce a level like this. And so because of the huge reversal from that point, right, in those first few days to weeks, it then produced a MACD level that was the highest we've ever seen. And so because of that, and because of the then gradual advance after that, those lines remained very close to each other, right? The MACD line and the signal line. And so it's taken this long to finally get the MACD below that. It has a long-winded way of explaining why we're getting a buy signal now and not before. But going forward, unless there's another really massive rally, those lines should stay relatively tight and probably going to see more buy signals and sell signals come to fruition over the next few weeks to months. And lastly, the GoNoGo charts. And this one has been interesting because, as the market was rolling over, finally saw a change here. And from all the way through the middle of May, as we've reviewed before, the GoNoGo indicator has been firmly bullish, right? It's been either in, full bullish mode or mildly bullish in green. That changed in the middle of November when we saw amber happen, which means things are neutral, which could be sliding into bearish, which of course happened. And as the market was pulling back, getting closer to 6,500, went to full no-go mode again, which we hadn't seen, since April as well. And so there was a concern that this could maybe be much bigger. And we talked about in the past comparing this to what happened in 2018. Because remember, in 2018, we went 3 straight months without any 1% moves from July, August, to September. And when October arrived, things really changed. And when this flipped from bullish to bearish, it nailed it for the next 3 months. That was a concern that could possibly happen. But so far, that hasn't been the case. And as we can tell now, over the last 2 days, it's been back to go mode. So it's a whipsaw. Now that could be frustrating, but let's go back again, 2024, from March to April, the same type of thing happened. And it's important to know where this started, right? This flipped to bullish about a week or so after the low in late October. And then when it finally triggered bullish, it lasted in a very consistent way all the way up until beginning stages of April, again, being whipsawed and then flipping back to go a little later in mid-May. And so, this is, again, another indication of what could happen when we have a pullback of, say, 6%. That was almost double what we've seen up to this point, which can then be bought and then create this second up leg like we saw in 2024. That's what we'll be looking for to the end of the year and into 2026. We'll be back with more videos soon. In the meantime, check out these other videos we have right here.